Hey, today I'm going to go over the basics of selling covered calls for guaranteed income. All right, this is a very powerful technique that anyone can use to extract money from the stock market anytime you choose. All right, this is just a basic beginner video of how to use it, but once you get the basics down, you can develop your skills to become a very powerful trader and make lots and lots of money. All right, let's get started. Okay, the first thing to do when selling call options is to pick a stock that you either own 100 shares of or you are happy to own 100 shares of. Okay, and the reason you have to have 100 or buy 100 is because all options pertain to 100 shares. All right, in this example, I've chosen Apple. So if I sell somebody an option to buy Apple off of me 30 days from now, that one option gives them the right to buy 100 shares from me. If I sell them two options, contracts, that gives them the option to buy 200 shares from me. Okay, so it's important you understand that whenever you're working with options, everything works in 100 share lots. Okay, once you've picked your stock, the next thing you want to do is look at the options available for sale in the market. And you do that by looking at what's called an options chain. Okay, and every broker has a different format of showing them to you, whether it's Fidelity or Schwab or whoever you use, they'll have an option chain for you to look at. Or you can come here to Yahoo. This is what I use for pretty much everything. It's free and it's got tons of information, easy to find. So let's go down here to options. And we click on options, and it gives you a bunch of numbers that can be pretty intimidating, kind of overwhelming. Okay, so just don't worry about any of that. There's only a couple things here that matter, and I'm going to point them out one by one. Okay, the first thing that you need to know is the date till expiration. Okay, that's often called DTE. That's something you're going to want to learn, the lingo. Someone says, oh, what's the DTE on the option contract? You know, that means date till expiration. And every option has a variety of dates that it offers, right? This is the market offering all these options down here at these expiration dates. So generally, I like to do 2 to 6 week out options. So for this example, we're going to do a 30-day option. Today's December 2nd, so we're going to go out to January 2nd, all right, just for demonstration purpose. So we click on January 2nd. That is the date of expiration for the option we're looking to sell. Okay, now the next thing you want to look at is the strike price. And the strike price is very important because if you are buying this Apple stock right now for let's say $285, you want to sell an option to somebody that's going to expire on January 2nd, 30 days from now, and it's going to give them the right, not the obligation, but the right to buy that stock off you at whatever strike price you choose. So naturally, for basic covered call option selling, you want to sell a strike price above what you paid for it so you make money. So in January 2nd, I'm going to sell you an option, or I'm sell back to the market an option at a strike price of, we're going to scroll down here, $285. Okay? Well, I want to make a little bit more. I'm going to go to $290. So I'm going to sell it at $290 strike price. And I'm buying it right now for $284.19. So in 30 days, if the person I sold the option to decides to buy the stock off of me, they will have to pay me $290. And I will get to keep the profit, which will be about $5.70. Really good deal for me, right? That's why I select this strike price. I want to make sure I make money if they decide that they buy my stock off me, because they're going to have the option to do that in 30 days. And if they decide to buy it, I want to make sure I make a profit from that purchase. Okay, the next part about selling covered calls, and this really is the most exciting part, and there's why. For that 290 strike 30-day option that I just sold to somebody out in the market, they are paying me up front today $4.31. Now that's times 100 shares. So that means you instantly receive $431 in your account, guaranteed income for yours to keep no matter what happens over the next 30 days, okay? That's the power of covered calls. Now let me repeat that. Like I said, you probably want to watch this video a couple times to make sure you understand all this. Okay, but for right now, just realize $431 goes into your account immediately, available for you to do anything you want, no matter what happens to that stock in the next 30 days. Whether it goes up or down or stays exactly the same, doesn't matter. You just made $431 guaranteed for you to keep. All right, that's the exciting part about covered calls. Okay, the next thing you want to know when selling call options is what's known as the bid and ask price. Okay, the bid is generally the price you're going to get when you sell a call, and that's what we are doing. We are selling a call, so this is the price we're going to get. Now, the person buying it, that's generally the price they're paying for it, and the difference between the two is called a spread, and that is what the broker kind of uses to manage the kind of sale, and they keep a little bit of money for themselves, I'm sure. So let's refresh this page at Yahoo, and let's go down and look at our example. On January 2nd, we're selling a strike of $290 for Apple stock. We're giving someone the option to buy it off of us at $290, and right now the bid price is $420 and the ask is $435. All right, so when I go sell this right now live in the market, it's telling me this is what I'm going to get, $4.20. I might get a little bit more somewhere in between here. I might get $4.25, but generally for your math, rely on this as your price. Okay, so I'm going to go out there to the market. I'm going to sell the covered call, and I'm going to get $420 right now in my account for this option. All right, very exciting. Okay, one other thing I want to point out, just so you know the lingo, is in the money, out of the money. Okay, it's two terms used often in options. And what out of the money means is that the strike price that you're referring to is above the current stock price. So right now, live trading is $285.10. Let's refresh this. So currently, out of the money would be anything higher than that. So $290 and above would be out of the money. And Yahoo does it by having a non-shaded area and a shaded. So now anything in the money, that is below the current price. That is blue shaded area, okay? Now for this basic concept that I just showed you, you want to always be selling out of the money, right? You're gonna buy the stock, whatever the price is, you're gonna go out of the money. One strike really is what I recommend you get started with. You can go two if you want, but I recommend you do one strike out of the money. So right now, if you were to do it live, you buy the stock for $285.08, you sell the $290 strike 30 days from now, you get $480 guaranteed in your account immediately. Okay, that's how you want to start off. Do a lot of these trades, practice them, watch how they work out, learn all the nuances. The more you do it, the better skills you're going to get. This really is a skill, right? This is not a science. This is not a art form. This is a skill set. And the better I get at options, I'm telling you, the more money I make for me and my family. So learn this basic principle and continue to move forward, all right? Okay, let's start with what happens if the price goes up. So you sold you bought your stock for $284.30. You sold your covered call at a strike of $290. And now let's say the stock went up to 300 within that 30-day period. So what happens now is that buyer of the option, since they can buy it off you for $290 and it's worth 300, they are most likely going to exercise that option. They're going to force you to sell your stock to them for $290. Now, when they do that, you get to keep the profit. Remember, you paid $284.30 for that stock. You're now selling it to them for $290. That gives you an additional $5.70 profit per share for a total of $570. Okay, so you already made the $435 guaranteed money 30 days ago when you sold them the option, and now you would be making another $570 when they buy the stock off you. Okay, very powerful. That's a lot of money in a short period of time on a $284 investment. All right, now let's see what happens if the stock was to go down. Well, if the stock was to go down, say to $275, well, now that option buyer most likely would not exercise the option. They would not force you to sell it. After all, why would they want to buy a stock off of you for $290 when it's now selling on the open market for $275? So in this situation, you would keep the stock. The option you sold them would expire worthless. What that means, you keep 100% of the $435 you received when you sold that option, and they lose 100% of their money that they paid for that option. That is why some people call options risky, right? Because they kind of make silly plays and they buy short-term options. Never buy short-term options. We're always selling. Very, very important. Look at that scenario again. I'm going to repeat it. It's worth repeating. It's worth you watching this video again to make sure you understand this. And that is, you guaranteed income to keep for you $435 the moment you sold them that option. Now that the price dropped by expiration, they lost 100% of their option that they purchased. right? They lost 100% of their investment. That is why options can be risky for some people who make foolish bets. Don't make foolish bets like that. Instead, be the smart person, sell covered calls to the market, right? We are always selling short-term calls. Now, what happens in this case? They don't call the stock away from you. You end up keeping it. So what do? You go out and you sell another 30-day covered call. Now, these are very basics, right, that I'm going over. Study it, practice it, and refine it and get better and better, and you will make a lot of money. This stuff is powerful. Learn the basics and go from there. All right.